The sticker price of a home in Texas is a lie. The number on the listing, the number you negotiate, even the number on the closing disclosure, that's not the real cost. The real cost is what starts after closing, when the keys are in your hand, the moving truck is gone, and the monthly bills begin to stack up in a way that feels less like homeownership and more like a long-term payment plan with surprise charges. Texas has sold itself for years as the land of affordability. No state income tax, big homes, new subdivisions stretching to the horizon, a place where a middle-class family could still buy space, still buy safety, still buy a future. And for a while, the math looked believable. But in 2026, the math is changing, and homeowners are discovering something that doesn't show up in the Zillow screenshot. The cost of owning isn't the purchase price, it's the carrying cost. It's the cost of staying. Because a home is not just a building, it's a contract with a county appraisal office, a contract with an insurance market that is increasingly panicked, and in many neighborhoods, a contract with an HOA that can raise fees with very little oversight. You can pay off the mortgage and still lose the house. You can buy new construction and still watch your payment rise year after year. You can do everything right and still get priced out of the same roof you already own. Let's start with the first hidden cost, the one Texas quietly uses to make up for what it doesn't collect in state income tax: property taxes. In 2026, Texas is sitting near the top tier of property tax burden nationally, often described as around the 6th highest in the country. The exact ranking depends on which data set you use, but the lived experience is consistent. Texas property tax is not a side expense, it is a second mortgage. And it's not just the rate, it's the volatility. In many places, the effective rate people feel works out somewhere around 1.74% to as high as 2.2%, depending on county, city, school district, and special taxing entities. That range matters because a fraction of a percent on a home's value is not a rounding error. It's thousands of dollars a year. And unlike a mortgage payment, which at least has a finish line, this bill never ends. Think about that for a second. A mortgage is supposed to be the hard part, 30 years of payments, then freedom. But property taxes don't respect that story. Property taxes don't care how long you worked, how carefully you saved, or whether you own the house outright. In Texas, you don't own a home the way you think you do. You own a liability you must continually pay to keep. To understand how brutal this can be, imagine a retiree, not a reckless investor, not a flipper, just a person who did what society asked. They worked for decades, they bought a modest home years ago, they paid the mortgage faithfully, they reached retirement, and finally, the day came when the mortgage was gone. This is the day most people dream about. No more bank payment, no more interest, just a home, paid for, a place to age in peace. Now picture the moment the retiree realizes the biggest bill didn't disappear. It got louder. Every month, the property tax portion hits like rent. And for this retiree, it's not a couple $100s a month. It's $1,200 a month every month for taxes alone. Not utilities, not insurance, not maintenance. Taxes. $1,200 a month is $14,400 a year. That is not a fee. That is a budget crusher. That is the difference between a stable retirement and a forced decision. Sell, move, downsize, or go back to work. And here's the cruel twist. Property taxes can rise even when your income doesn't. Many retirees live on fixed incomes, Social Security, maybe a pension, maybe withdrawals that are carefully calculated to last. But the county doesn't care about your income. The county cares about property value, and property value in Texas has been volatile, especially in markets that saw explosive growth. When values rise quickly, taxes rise quickly. Even with exemptions, even with caps in some cases,
homeowners can still get hit with a painful increase, and the shock often arrives in the most infuriating way possible: the escrow analysis letter. Escrow is where lenders collect taxes and insurance alongside your mortgage payment. If the lender believes the property tax bill is going up, or if the prior year's escrow was short, your monthly payment can jump. Suddenly, the same mortgage is not the same. The homeowner sees a new number, hundreds more per month, sometimes more. And the homeowner asks the obvious question: how can my payment rise if my interest rate is fixed? Because your interest rate isn't the only thing in that payment. In Texas, the tax and insurance line items can grow faster than the principal and interest ever change. A fixed-rate mortgage can still become an unstable monthly obligation. Now zoom out from that one retiree, multiply that story by hundreds of thousands of homeowners across Texas who bought during the boom and then got reassessed and then got rebuilt. This is the trap. It doesn't feel like a typical housing crisis where people lose homes because they bought too much house. It feels like people lose homes because the carrying costs outran reality. The second hidden cost is insurance, and in 2026, insurance is becoming a crisis that changes the definition of affordable. Texas is increasingly a state of extreme weather: hail that destroys roofs, wind events that strip siding, flooding that turns streets into rivers, hurricanes along the coast, and the compounding effect of repeated disasters is a private market that begins to behave like a cornered animal. Insurance companies do two things when risk rises: they raise premiums or they leave. Homeowners are discovering that the monthly cost of protection is no longer stable. In 2026, many Texans are seeing premiums jump dramatically, sometimes by numbers that feel impossible, even reaching increases around 40% in a single renewal cycle in some cases. And when that happens, the mortgage payment doesn't just go up, it can leap. Because again, insurance is often escrowed. When your insurance premium jumps, your escrow payment jumps with it. And if you're short, you may also pay an escrow shortage catch-up on top of the new higher premium. That's how a household can get hit with a double punch: higher ongoing costs and a temporary surcharge. Now imagine explaining that to a family budget, a family that already stretched to buy a home, a family that believed Texas was the place where they could finally escape expensive housing markets. They didn't move to Texas expecting the insurance market to behave like a disaster zone. But that's the reality. In 2026, Texas is increasingly earning a new nickname in the minds of homeowners who can't believe their renewal notices: the uninsurable state. That phrase sounds dramatic until you see how it plays out. If insurance becomes too expensive, you can't simply skip it. If you have a mortgage, insurance is typically required. If you cancel, your lender can force place insurance, and forced place insurance is often far more expensive and provides less protection. Even if you own your home outright, going without insurance is not a simple choice. It's a gamble against hail, wind, fire, flood, and the rising cost of rebuilding. The price of materials and labor can spike after disasters. Contractors become scarce, permits slow, and suddenly a small storm becomes a life-changing financial event. There's also the slow poison that doesn't make the news: coverage shrinking, higher deductibles, more exclusions, roof schedules, actual cash value policies that pay less. Insurance isn't just getting more expensive, it can be getting worse. This creates a psychological shift. Homeowners are no longer paying for peace of mind. They are paying for the right to keep a mortgage compliant, for a product they trust less each year. And in a state where weather volatility can be brutal, that fear is rational. If you live under hail risk, you can be one storm away from a claim. If you live near the coast, you can be one season away from a premium shock. If you live in a flood-prone area, you can be one event away from discovering you were underinsured. Now combine property taxes and insurance, and you get the real Texas housing number. Not the list price, not the payment the lender quoted at closing, the number you live with after the county reassesses and the insurer renews. And this is where the myth collapses. Texas is not automatically cheap. Texas is cheap on the headline, expensive in the fine print. There's a third hidden cost that's less talked about but increasingly unavoidable, especially in the sprawling suburbs that grew fastest: HOA fees. Homeowners associations were marketed as a benefit. They keep the neighborhood clean. They enforce standards. They maintain common areas. They protect property values. But in many Texas suburbs, HOAs have become their own cost center, with fees that can rise and rules that can tighten with little transparency for the average resident. And the biggest problem is that for a lot of homeowners, HOA fees feel unregulated. If you live in a master-planned community, you may have multiple layers of fees, one for the neighborhood, another for the broader development, sometimes special assessments, sometimes fees that rise because insurance for common areas rose.